I hear you. Real estate has been tough, and it has investors dropping out of the game like flies these days. Sellers want too much money. Banks are tightening up. Interest rates are still high. Almost no deals make sense on paper. So how do you continue to find good, profitable flips and rentals that actually make sense to build your portfolio? The truth is, it's not all about how much you can offer. That's a common misconception. The real power is in how you offer it. That's how we consistently use strategies to lock up profitable deals regardless of what the market's doing. It's how you offer it, how you structure the deal. In this video, we're going to show you a few very powerful offer strategies that you can use to win more contracts and close more deals in any market. Let's jump in.
Hey guys, let's talk now about some advanced strategies that can win you more deals. To start with, one of the strategies that we use that we have found very, very helpful is that we try to offer multiple offers initially. So if, especially in a hot market where we know we might not have the best and highest cash offer, we give out some other alternatives to kind of present the seller with some options and ways to think about how this deal could be structured and what would work best for them.
We're going to talk through some of the other offers that we include in our multiple offer strategy. Ideally, we shoot for 3 offers. We always submit at least 2, but again, that 3, which includes the 1 being the cash offer and 2 of these other options that we're going to talk about, it depends on the deal. It depends on the numbers. It depends on the situation. Okay. Is this a property you're just trying to flip because it does not completely fit your buy box, but it's a great opportunity? Is this a property that you want to buy and hold? It's going to work with your core strategy. So depending on where it lands there is going to determine what the other 2 strategies are. But again, we're always leading with that cash offer because in accordance with our strategy, we are looking to be all in at 70% of the ARV or of the stabilized value. Basically, we buy it, we fix it up, and then when it's all said and done, all of our costs and everything baked in, we are into the property for 70% of what the true market value is. That's a great place to be. You always lead with cash, but you have a great deal if you can get that done. So you lead with that. Now let's talk about the intro to creative finance. So what is creative financing? If you've been in real estate or you've been around for any period of time, you've probably heard more and more and more about creative finance lately because it involves strategies and methods to basically make deals work when it's tough to finance them conventionally. What that often includes is basically the seller holding a contract of some degree on the property that reduces the amount of money that you have to bring to the table to close, or that provides you financing terms that are better than you would get working with a bank.
This is where it's helpful to have done some research and to know a little bit about the seller and the situation they're in so that you know which of these might work for them in their current situation.
Yeah. So let's talk about some creative finance strategies that are common today and ones that we use. Seller finance. Every deal that we basically are closing these days, we are offering some seller finance component. And then what seller financing basically involves is, again, the seller holding the contract for an amount, a portion of the purchase price or the entire purchase price. Very rarely are you going to get somebody to hold back the entire purchase price. But essentially, if they have equity in the property, seller financing is a way for you to basically make the seller the bank. And instead of you going and bringing new financing to the table and maybe putting down 20% and having a loan with a 6 or 7 or 8% interest rate, you can negotiate with the seller and say, hey, seller, will you hold 50% of the purchase price for 5 to 10 years? Longer is better because it provides you more stabilization in the deal if you're not going to have to go and figure out how to buy them out in the next couple of years. So again, the same terms that you would negotiate with a bank or that you would get from a bank, you basically negotiating for more favorable terms from the seller. And you can disguise the limit with seller financing. It's whatever they will agree to. There's folks who negotiate for interest only for 20, 30, 40 years when sellers are not really interested in getting all the money up front. And they essentially turn the property into an annuity that continues to pay them out over time, right? Some folks will accept more or less. You can play with the interest rate. You can do no interest. Again, the sky's the limit depending on who you're dealing with and what their goals are.
Yeah. And I was just going to say, currently, what we're seeing sellers be most open to is holding some sort of note for, and usually, obviously, like Tyrone said, it's usually not for the whole sale price. It's usually for a portion of the sale price. So we can secure primary financing. They're holding some money and it's for a shorter period of time. I think your example was 5 to 10 years. What that allows us to do is to stabilize that property and then refi or sell down the line, and pay off the original seller.
So by doing that and opening up those lines of communication, you might be able to actually present a situation to the seller that didn't really think about it. As long as you can articulate this clearly and it's clear that you know what you're doing, or that you at least know how to get this done, right? Some folks would basically prefer to receive the money from the proceeds from the sale in payments. For instance, if this was an investment property and they receive all that money in one big chunk, they're going to likely have to pay taxes on that whole big chunk of money. If they actually hold a note or hold a contract on the property and they let you make payments on it like a mortgage, they're only paying taxes on that money as they receive it, right? So that's one situation where we've been able to talk people into the idea of seller finance when they at first weren't really seeming very open to it until they realized what the benefits were.
And again, depending on this is also where it's good to know what your seller is trying, why they're selling the property and why they're selling now. What goal do they have for their next step in life? And so if you can help them reach their next step, but they're able to help you secure the building, it might work with the property.
So again, seller finance works, just to recap. Seller has equity in the property, right? They can't finance what they don't have. If they're trying to sell you a property for $1 million and they owe $900,000 on it, that doesn't work. So they have to have equity in the property. They have to be okay with not receiving the full amount of their proceeds in one lump sum for some reason, right? And you want to negotiate to secure that seller finance component for it as long as possible. Again, unless you're just flipping the property and you're planning to resell it and you have a very solid plan, a business plan for how you're going to get that done, execute that. If this is for a buy and hold rental, you want to secure those good terms for as long as you can, because you don't want to be in a position where you're forced to refi the property and interest rates are higher in order to close, pay that seller off. And then you might be in a position where it's not going to be cash flowing after you do that. Lease options. This is another strategy that we have used specifically with rental properties, is when this makes the most sense. On one lease option deal that we recently did, this was a master lease option deal. So it was on an 8-unit building. Essentially, a lease option is basically, you can look at it as being two contracts in one. And a lot of times it's structured as two contracts, which is what we did. So there's a lease on the property. In our case, it was a master lease because it was a multifamily property. So it means that we're leasing the whole building from the owner, and we have the right to sublease all of the units so that we control the building. And then you have an option, which is an option to purchase the building for an agreed upon price that you're going to put into that contract when you sign it. So between the two, we basically secured the ability to buy this property at a price. And then because we had the master lease option on the building and the rights to basically improve the building, we went through and we flipped over the units and we renovated the building unit by unit and got the recs up. And we basically performed our value add business plan on this building before we actually closed on it. And we made sure the contracts were airtight. We were covered for all the money that we were putting into the building. But at the end of the day, that enabled us to basically fund most of all the renovations using cash flow from the actual building. And then when we closed on it, we closed on the building. It was worth basically $200,000 more than the price that we had written into the contract. Imagine that. You get the contract for one price. You use the cash flow from the building to actually fix it up. And then you close on it and you have $200,000 in equity when you close on it.
So I was going to say, let's kind of list out the pros and cons to both the seller and the buyer in that situation. So I was like, a lease option works really well for a seller who isn't necessarily looking to have a cash influx, like to actually sell the property immediately, but they're looking to eliminate the headaches of the property. So they're not having to worry about tenants or evictions or improvements to the property. They just don't have the headache of the property. You're assuming all of the responsibility of that property. They know that they're going to get one monthly rent, essentially rent payment from you, the buyer. And so you're paying them directly, one lump sum, and they don't have any headaches. And then they know that they're going to sell it at an agreed upon time, an agreed upon date for an agreed upon price. And so like, okay, if I know I'm going to get X amount of dollars in a year and I don't have to have any headaches right now, but I still make income while I hold on to it for a year. I'm going to hold on to it, make a secure income, and then I'm going to sell it for this price, guaranteed sale. At the end, it's kind of no hassle for them. And then like Tyrone said, as the buyer, it's great because then you have control over that building. You're making those improvements, you're improving the tenant base, etc., and you're increasing the value of the property.
Yeah, and you're mitigating your risk,
Mhm.
like the risk associated with you buying the property for that full price and having to put out all the extra money in capex to fix up the building while you're dealing with turnovers and all that. Imagine doing that while you're just taking a portion of the money that's coming in and paying it to the seller, and then closing that gap before you actually close on the building. And kind of in line with the point that you made, the deal that we most recently did, the seller was relocating to retire to Florida and just wanted to be gone. I want this much for the property. I understand that certain things need to be done before you can buy for that much. I'm ready to get out of here. And then that deal made sense for them, and it made a lot of sense. It was a win-win for both of us, and we made out very well in that.
And also is like that opportunity where if the seller wants more for the property, then what you, the buyer, would be able to actually be able to buy it for based on what the produced income actually generates and what you could actually finance. This gives you the opportunity to increase the value and get better financing. And so you can actually.
That we have used several times, two of our very favorite strategies. And those are actually the two that are typically part of our three offer strategy. Because again, we're dealing with mostly value add rental properties. So they both make perfect sense when you're actually taking on income producing property. The other one that we're going to talk about is novation contracts. Novation contracts, number one, they don't only apply to real estate, right? It's just a type of contract. And typically what you're doing in a novation contract is you are exchanging one party in the contract for another party. So say if party A signs a contract with party B to buy a property for some agreed upon price. An novation contract would allow party B to actually exit the contract and party C to come in his or her place, right? So essentially, if you think about it that way, you are basically exchanging parties in a contract, one for somebody else. You can also use novation contracts to exchange terms of a contract, but the context that we're going to talk about is basically if you are exchanging parties, right? And this is a strategy that is very useful for short-term projects where, say, you're going to flip a property. So essentially, you might be negotiating with a seller and say that the seller wants $200,000 for the property and you can't afford to pay that much. You're like, seller, once I fix the property up and so forth, I'm going to be able to find a buyer for probably $250,000, but I can't pay you $200,000 because that's more than it's worth right now, right? What you could do is actually secure a novation contract that gives you the right to go and find the buyer who's going to come in and buy that property for $250,000. And then when that happens, you basically pay the seller off the $50,000. I'm sorry, the $200,000. You take the 50, and there the seller got their price, you got your profit, and the new party who came into the deal got the property that they were in the market for. So that's kind of a loose understanding of how it works. Another way to think about this and how we've executed it before is basically it's also sort of like a joint venture deal. If you're talking about listing a property, there's also called a thing called net listings, right? So these are all forms of novation contracts. In the joint venture deal, we go to a seller and we say, hey, we want to buy this property. We can only afford to pay you X amount. They want more than that. So then we say, okay, we'll joint venture with you to basically secure our ability to perform upgrades to the property. And then once we secure the contract to sell it to the new person, you get made whole, I get my profit, they get the property, everybody walks away and everybody's happy, right? That's just a very simple way. So that is something that can be very useful for flip deals when there's just not enough margin to close the gap, but there's profit to be made once the property is fixed up.
So you're essentially partnering with them where you're agreeing to take on any renovations and make any improvements to the property if they're willing to wait for their sale price.
Yeah. And essentially you can just come out of pocket those repair costs or even bring another partner to the deal or raise the repair costs to actually fund the renovation. And that way you're basically securing a property with no money out of pocket. And then when it all closes, everybody gets what they wanted. You get your profit, everybody walks away, everybody's happy.
And again, that works for a seller who wants a certain price, but doesn't necessarily have the means or resources to make those improvements him or herself. So they're willing to give that off, hand that off to you as your responsibility.
Yeah, those are the most common creative finance strategies that we've used in our business, to grow our portfolio, and they've worked very well for us. Another type of creative finance strategy that you will hear about is what's called sub two, kind of as the nickname for it. And basically what that means is that you're buying a property subject to the existing mortgage or subject to the existing financing that's in place. We have looked at deals and looked at the potential of doing that. We personally have not come across a deal where it made sense for us to do it. So we don't employ this strategy. Although people do. If that's something that you're interested in, definitely reach out to us and we can point you in the right direction in terms of getting more information on how that works. But if you can get a seller to agree to any of these terms, you can then go to the attorneys and figure out the legal side of the situation, right? Just keep that in mind. Keep it open mind. You're leveling with the seller. You're looking eye to eye and you're saying, okay, how can we make this work? And then you're offering them options. We could do the cash thing. I know that that doesn't look too attractive to you. You could do the seller finance thing. You go, oh, no, we do the lease option thing. Give me some time to fix it up a little bit and then I'll close. We could do a novation or a joint venture. I can purchase a subject to your existing financing, and you explain, I can give you better price if I don't have to bring a bank in here to clear out that existing mortgage in place. And then we rely on the attorneys to make all of this stuff official, right? Because that's not us.
So just be prepared to explain these creative financing options to either the listing agent or directly to the seller if possible. And if it's listed, I always request a conference call with the seller. Sometimes a listing agent will agree to it, sometimes not. But no matter what, I always try to have a phone call after we present the multiple offers so that we can really go through and explain. Because a lot of, especially agents, and sellers as well, depending on how advanced investors they are, they might not understand what seller financing is or what a lease option is, or they have inaccurate perceptions of what those things are. So us sitting through and really talking through what that could look like has been really beneficial. They can make sure everybody's on the same page and has the same understanding of the offers we're presenting.
Yeah, it's very important to know and to keep in mind that most people don't understand what these things mean. They're very powerful strategies to lock up and secure more deals, but they're often shot down before you can even start a conversation because the agent doesn't understand it. If you're dealing directly with a seller, if you haven't done your research and basically walk through how to explain this and know how to articulate the position, you confuse a seller, then it's not going to work. They're going to try to understand something that's confusing them on how you can pay less money out of pocket to get their property, right? So it has to be clear, it has to be concise. And again, that's best done when you're having those one-on-one conversations. So
And leading with how it could be a benefit to the seller, whether that be a tax advantage or whether that be a headache reduction. But you're talking through how this can get the seller what he or she wants out of the sale of the property and can make this deal work for both parties.
yeah, and this is even more helpful and more of a tool for you because again, you've gone through all the other processes that we've talked about to this point. You have a pretty strong rapport built with this person you're trying to do this deal with, which is why they're even listening to you, most likely about these things if they don't understand them, right? You're more likely to get that conference call with the agent after you've done the other things, building that rapport, coming across as a real person, leading with value, right? Negotiating in good faith. You've built that position to be able to break those barriers down and get in, right? Versus if you just call somebody and, hey, you want to do a lease option it to me? Like, if that it's not going to go anywhere, right? So just keep that in mind. We will see you in the next video where we're going to wrap this module and it's coming right up.